There's a lot of public interest in trading stocks for companies that are soon to file for bankruptcy, have already made the announcement that they will file for bankruptcy, or are just on the cusp of the bankruptcy process. Because there's a lot of fervor for them, there's a lot of interest, these stocks have traded tremendously high. And I wanted to actually talk about that because I thought that was interesting. Part of me had been on the fence about bankruptcy investing or pre-bankruptcy investing because it's very obvious at face value that people are just jumping in on this for novelty's sake. Are these actually companies that can turn things around? And in most cases, all the popular ones in recent history, like Hertz, JCPenney, Pier 1 Imports, and then of course recently Bed Bath & Beyond, have all been the worst kinds of businesses to jump in on buying their stocks pre-bankruptcy. They've been the worst for so many different reasons, and I can actually get into that. They're calling them meme stocks. And they're calling them meme stocks because people are creating memes. It's a meme culture around them. And if you're already involved in this and you're familiar with Reddit culture, I don't need to explain this to you, but for those of you that don't know, there is a culture around failing businesses because once a company that is long been forgotten, like Bed Bath & Beyond, Hertz Rental, Pier 1 Imports, JCPenney, long been forgotten. You don't shop there, you don't rent their cars, you have nothing to do with them. They come into the headlines again because of bankruptcy. Suddenly, the trading volume goes up. People assume, well, hey, now it's getting talked about. Other people are going to trade it more, so therefore, I should jump in on this and trade it. It's the circular reasoning that creates more traffic for it. And a lot of people also buy in because of the amount of short interest. And they want to jump in before there's a short squeeze or to create a short squeeze and then ride the stock even higher. But I just want to talk about bankruptcy gains. That's the title of the video, bankruptcy gains. That's important. That is important because as I investigated into this, these multiple reasons I talked about as to why people are jumping into the stock, everyone I know would immediately dismiss this as that's meme culture. That's people trying to create a short squeeze or manipulate the stock. They're investing or they're gambling technically for no reason, no solid reason. They have no idea what they're doing. All of that is true, but what can also be true in the same space is that there's validity behind bankruptcy investing. In 1999, there was a paper done. This paper that was published in the Journal of Banking and Finance by these fellas, Daniel Indro, Robert Leach, Wayne Lee. I hope you guys are still around. And if you're not, well, you wrote one hell of a paper. And it's still useful today. And I hope that you guys watch this video and you can appreciate this paper that was published in 1999, because they give different metrics you can look at to decide whether or not a company will survive a bankruptcy, if it's likely that they will. And I'm just going to break down their findings. So number one is this: half of businesses that file for bankruptcy are not going to make it out the other side in one piece. Meaning they'll either get acquired by another business or they'll completely liquidate. And in either scenario, if you are a stockholder before either of those events happen, you lose. You lose your stake to the acquiring company. Almost every single time when there's another company acquiring you while you're going through bankruptcy, they're going to buy your stocks at a discount, which is not good for you because you want to make a profit. But then there's another half. Survive the bankruptcy, they emerge from it, and their stock appreciates. And there's reasons why this happens, and it's for a lot of the reasons I even just explained. These are typically long forgotten businesses that people haven't shopped at or engaged with in a long time. As their company is failing, people are losing interest that are current stockholders, so they sell the stake out, and eventually the price goes so low where the company is just undervalued. While these businesses are undervalued, you had basically a coin toss chance at making really incredible gains. Based on their study, they found that of the businesses that emerged from bankruptcy, they had gains between 45%, which was on the lower end, upwards of 70% in the next year. And those are the returns for that year, annualized returns. And the returns continued to grow for well on after that in most of the cases. But if that was what happened, if you had winners born out of bankruptcy, well, what about the other half of the time when they didn't win? What would happen then? Well, they would just disappear off the face of the earth. As far as you were concerned anyway, if you were a stockholder before the bankruptcy, it didn't matter. They failed, they went into bankruptcy, they were acquired, or they just liquidated, they disappeared. Your stock became useless. So all the short sellers that sold or shorted the stock before the bankruptcy kept 100% of the proceeds from the sale because the stock disappeared. They didn't owe anybody a stock back. They keep 100% of their profits. But for the other half of the time, if you're an equity investor and you invested in a certain type of business, there's certain metrics that they called out. The business had to be in a concentrated industry. That's important. Meaning it was an industry where maybe there were like 4 or 5 really big competitors in the same industry. That's super concentrated. That means that you don't really have a lot of competitors, and there are likely high barriers for entry. That leads me to the other point is if it requires a lot of assets and very specific assets to get into, then that also increased the likelihood for outsized gains if it survived the bankruptcy. The other thing is also the structure of their debt. If they had a lot of private debt on their books, it was very likely they could restructure easily by issuing those private creditors stock in the company in exchange for clearing the balance sheet of that debt. Just from looking at this from a layperson perspective, is there still a way to find out if a business is still worth it? It's 2 things, 2 very simple things. Is it a good business? That's number 1. If the answer is yes, then we're halfway there. But is it a good business with a lot of debt that we can restructure on those terms or restructure the debt entirely? If the answer is yes to the debt part, then the rest is really easy. You have a greater than 50% chance of making a 60% gain within the next year. There is a science behind investing in businesses that are soon to go into bankruptcy or have announced that they will go into bankruptcy. And there's a legitimate reason as to why you would do that. And I think it's something that we should look further into. Because here's the thing, if these businesses survive and they're great businesses, then what you did is you bought a distressed business that was deeply undervalued, and now that it's on the other side of bankruptcy, it's cleared the debts or most of the debts that are ailing it, then you have a good business. You went from being undervalued to being something that is correctly valued. Compare that to a market portfolio of the S&P 500. 500 of the largest companies, all in an index, in a group, that average annual gain is between 8 to 11%. 40 to 70% is a huge deal. Now, I just want to say this is a disclaimer. I'm not condoning that you just take up only bankruptcies as a portfolio strategy. That's not a workable strategy if you are not an analyst, because I do think that a lot of these businesses need to be analyzed by someone who has experience. Anyway, folks, thank you so much for watching. I thought that I would just share my piece on what's going on as of late, because it is an interesting topic, is it not? I mean, the fact that people are making incredible returns from bankruptcies, right? That's awesome. Anyhow, thank you for watching. If you'd like to see more content like this, of course, please do like. If you've got your own commentary about the companies I've talked about before, please leave me a comment in the comment section. I am very open to discussion from all 10 of you now that watch my videos, and thank you so much for watching. Take care.